Hi there, I'm Dermot, bringing you this update on Eastern and Central European emerging markets with Cristian Maggio, Senior Emerging Market Strategist at TD Securities in London. So Cristian, currencies such as Poland's zloty and the Bulgarian lev are up against the dollar since May, while we are seeing record low drops from the India's rupee and of course Turkey's lira. So do you think Central and Eastern Europe has become a relative safe haven within emerging markets, and do you think this sentiment will be maintained over the coming months?
Emerging European economies have performed better, much better than most other emerging countries in terms of FX performance. And that also reflects the fact that most economies within the Central Europe, Eastern European region have had a better performance on the fixed income side than Latin American and Asian peers, for example. So this is one thing that we see. But I would not come to the conclusion that Eastern Europe has become now the new safe haven of emerging markets. Because as a matter of fact, if you look at the resilience that most economies in the region are exhibiting to potential external shocks, which means basically a sudden interruption of external funding like it happened back in 2008 and 2009. As I was saying, most of these economies are substantially weaker than the average Asian or the average Latin American economies. So if worse comes to worst, these are the economies that would still get the biggest hit. And the reason why FX performance has been better than that recorded in the other regions is just probably the fact that Eastern European economies have been suffering for a longer period of time, and they have started to recover slowly but steadily, with also the improving expectations on growth for the Eurozone. So that's probably the main anchor for the relatively good performance of currencies in this region so far.
And if we look specifically at Poland, its retail sales for July rose 4.3% from the same month last year. This actually surpassed expectations for 2.8% growth. Would Poland be one of the countries that you would be feeling more bullish about, or would you say you're more actually bearish on it?
I'm not very bullish, but I am improving my outlook on Poland. Definitely the latest slew of data has been quite positive in Poland, mostly exceeding consensus expectations, also on the inflation front. But even in this case, I wouldn't go to a quick conclusion that interest rate hikes are imminent or foreseeable in the near future, because what a central bank has to do, after all, is to basically control inflation. And then when inflation is under control, their secondary target can be growth. And in Poland, inflation is still at 1.1% year-on-year, which means it's 1.4% below the target. And on top of the target, you have another 1% of tolerance that defines at 3.5% the upper end of the inflation target range. So if you take that 3.5%, we're still way below that, and the central bank will still have a long time to go before they have to react to rising inflation to start anchoring inflation expectations. So this is just to say monetary policy will remain accommodative for now, especially throughout this period of rising uncertainty. And if the central bank is pushed to react earlier, that is not on the ground of inflation, but is rather on the ground of increasing risk aversion that could put under severe pressure the zloty going forward, and that would maybe, but just maybe in extreme circumstances, require the MBP to be preemptive in their tightening monetary policy.
And in terms of Hungary, where it has actually extended its rate cutting cycle, and of course its most recent cut was a record low, do you think it is on the right path to improving its economy? And do you think investors are reacting positively to its policy decisions?
I mean, all the rest being equal, when you cut interest rates, that adds some positive contribution to growth at the margin of what has been previously delivered. Now, the central bank in Hungary has delivered pretty long and deep monetary easing cycle so far, and they have signaled their intention to continue along those lines. But what they did last time is something new and unusual. The market was prepared for, although the market was looking for a smaller 10 basis point cut. And the novelty in this case is that they introduced steps in fine-tuning the monetary policy that are smaller than the conventional 25 basis points that most central banks worldwide utilize. So they delivered a 20 basis point cut, which to me was trying to respond to two opposite instances. One is to continue accommodating on growth, and on the other hand, trying not to unsettle the markets given the external uncertainties and troubles that Hungary as well as other emerging markets has to deal with. So they reduced easing by 5 basis points to 20 basis points after having provided guidance that they were probably going to proceed in steps of 10 basis points. So they managed to be inconsistent on two fronts, on the guidance that they provided about their own rate decisions, and in cutting rates by an amount that is very close to the conventional 25 basis points, but they just did 5 bips less, which is not meaningfully different from a quarter percentage point. So in conclusion, I think what they're trying to do is they're just trying to test the water to see how the market reacts, but overall try and push interest rates lower to between 3 and 3.5%. So we will see most likely new lows in the coming months. The effect on the economy, as I said before, is definitely positive, but we have already reached a point that these incremental reductions of interest rates will not generate that positive effect as the previous one, when interest rates were substantially higher than they are today. And on top of that, we will see inflation continuing to rise in the coming months, which means that also on the inflation front, they will have to interrupt at some point monetary easing. So we are very close to the end of the cycle now.
Thank you, Cristian, very much for that. Well, viewers, that is it for right now, but do also make sure you have a look at my commodities corner, as I will be looking at oil and Syria. But for now, goodbye.